Gold exchange traded funds, which track the performance of the yellow metal, are down about 3.4% over the past 3 months. Unless there is a meaningful slowdown in the US economy or a repeat of something like the banking crisis that occurred in the early part of this year, gold's underperformance may continue for some time, says Ghazal Jain, fund manager, Quantum Mutual Fund. In a wide-ranging interview with Business Standard, she discusses the reasons for this current bout of underperformance, the circumstances that could bring about a turnaround in the yellow metal's fortunes, and why retail investors in India need to have at least a 15% allocation to gold at all times. She also dwells at length on the key economic parameters that influence the price of gold, something that the yellow metal aficionado within you will find very interesting. Do watch this interview to learn more. Good morning and welcome to our show.
Hi, Sanjay. Thank you. Thank you for having me.
So, the typical gold ETF has been down about minus 3.7% over the past 3 months. And the longer term, about 1 year performance is quite robust at 12% or so. So we want to understand from you what is responsible for this recent downturn in performance.
Sure. So, if you recall, gold prices ran up in March, April 2023, the start of the year, in response to the US regional banking crisis and the resulting risk aversion. The financial stability concerns led markets to price in multiple rate cuts in 2023, which drove up gold prices, which in our view was overly optimistic. Also, there was this uncertainty regarding the US debt ceiling and a potential US default, and that was also supporting some, trade in gold. So once the debt deal was approved and it became clear that the pain in the US banking sector had not spread, it kind of gave markets the idea that the Fed will not be compelled to cut rates soon. And that's when we saw gold prices, cooling off in May and June, because markets started repricing their interest rate expectations from multiple rate cuts in 2023 to about just one rate cut in 2023. Right. Also, in the June Fed policy meet, even though the Fed took a pause from increasing rates, this was seen as a hawkish pause because they indicated 2 more rate hikes in 2023. Right. And this also weighed on gold prices. And currently, the weakness we're seeing in prices is also because, markets have completely written off any rate cuts in 2023. So, this underperformance of late can be attributed to these reasons.
What factors could drag down the price of gold further from these levels?
Sure. So currently, we are seeing a disinflation momentum in the US. But if you go into the details, you realize that core inflation, which does not include food and fuel prices, it still remains well above the Fed's 2% target, and it is looking quite sticky. So, there is a sense that it could be more difficult or it will be trickier for the Fed to bring inflation down, from these current levels going forward. Also because, the positive effects of high base are now going to move out over the next few months. So, that kind of remains, an issue. And on the other hand, the US economy, even though we are getting some mixed signs, different macroeconomic indicators throwing up very mixed signals. But the US economy hasn't shown any material signs of weakness. So this is giving, the impression to markets that there is more room for the Fed to tighten, and some tactical hikes in the near term cannot be ruled out. And we believe if that happens, we could see some more correction in gold prices in the near term.
And in what kind of a situation could we see a turnaround in the price of gold?
Yes, so I think some kind of economic instability, maybe similar to the regional banking crisis of March, or if we see a meaningful growth slowdown, in the US, something of this or some sort of market instability could, lead the Fed to abruptly cut rates while inflation is, at these elevated levels. And that kind of environment would really be positive for gold prices.
What would your advice be to a new investor in gold? How much asset allocation should they have to gold? And with what kind of an investment horizon should they enter into it?
Sure. So, given gold's characteristics as a portfolio diversifier and a source of liquidity, a preserver of purchasing power, I think my advice to new investors would be to not see gold as a tactical asset, see it more as a long-term strategic asset with a strategic role in your portfolio. And based, on our analysis of 15 to 20% exposure to gold is, ideal in a portfolio. It can lower risk for the portfolio without compromising on returns. And currently, if you're a new investor just starting to, looking to build your allocation, I would say avoid lump sum purchases because the prices are close to all-time highs. And if there are any rate hikes by the Fed over the next few months, we can expect some volatility in gold prices. And those opportunities of consolidation can be a good time for you to accumulate gold and build your allocation.
And what's the advice to existing investors? Do they need to hike their allocation, reduce it? Is there any advice of that kind?
Sure. So, in this uncertain environment, I think my reminder to existing gold investors would be risk management is as important as return generation. So please, maintain exposure to gold based on your asset allocation strategy. Don't go overboard. 10 to 15 to 20% allocation to portfolio diversifiers. Gold can be good. And any new buying that existing investors want to do, please do it in a systematic, staggered way, and avoid any lump sum purchases at these levels.
Now, we have finished the first part of the questions, which was more on outlook for gold prices. In the second part, I want to discuss with you how some of the key economic variables affect the price of gold. A lot of times for laypersons like me or my viewers, when we read a report on gold, there's a lot of discussion, say, about the US Fed's action, the labor market in the US, and a lot of us really struggle to understand how these correlate with the price of gold. So these questions are pertain to those issues. So my first question is, when we discuss the price of gold, why is the focus more on in the international economy, say on the US Fed's actions rather than on the RBI's actions?
Sure. So most of the gold in India is imported, right? So domestic gold prices are derived from international gold prices. We use, the USD INR conversion rate and add the various duties and taxes. And then this domestic gold price that is derived is like a benchmark gold price. So coming to why we track, the US economy or the international economy more when trying to, understand where gold prices are headed. Now, gold is dollar denominated. It's a dollar denominated asset class. So that means the prospects of the US economy and the trajectory of the dollar influence gold prices more than anything. Right. Of course, domestic demand and supply conditions also influence domestic prices to some extent, leading to local prices trading at premium or discount to the benchmark price. But essentially, the driver of gold prices would be the international or the US economic environment and the Fed policy.
So essentially, we are price takers. We
Right.
take prices from the international economy. Now, is the prospect of further rate hikes by the US Fed a positive or a negative for gold?
So, fundamentally, gold does not pay any interest, unlike bonds, right? Returns on gold are a result of the price appreciation that the metal sees. So, higher interest rate on bonds increases the opportunity cost, or you can say the carrying cost of holding gold, and is thus generally negative for the metals prices. But in the current context, if the Fed continues to tighten further and the markets get a sense that the Fed may over tighten and push the economy into a deep recession, the risk aversion could actually support flows into gold. But fundamentally speaking, higher interest rates in the US would be negative for gold.
Now, when we look at equities, we know that there's one fundamental variable that affects equities performance in the long run, and that is earnings per share. Is there a similar variable that affects the price of gold? And if so, is it real interest rate or something?
Sure. So it is actually real interest rates. So let me explain the relationship. So real interest rates are negatively correlated with the price of gold. So rising interest rates adversely impact the metal. Now, let me explain why this happens. So gold prices tend to increase significantly during periods of negative real interest rates. For an example, why is that? Because negative interest rates, first of all, what are negative interest rates? A situation when the inflation rate is higher than the nominal interest rate, right? The rate that is actually paid. So when these real interest rates are negative, what it means is the bondholder actually is losing money, right? The interest he is getting is lower than the rate of inflation. So these bond investors then may be more prone to buy gold, or they may prefer to buy gold, right? Even though it does not bear interest. And because of that, when real interest rates are negative, preference for gold and hence prices for gold go up, and vice versa.
Now, how does the strengthening or weakening of the dollar affect the price of gold?
Okay, so gold and dollar also share an inverse relation, mostly. For example, so when the USD weakens against other currencies, the value of those other currencies, of other countries increases, and they are in a position to buy more gold. So when the value of a local currency increases, the demand for commodities like gold increases, right? So increase in demand for gold then causes the increase in price of gold. So in short, a weaker dollar increases the demand for commodities like gold in other countries and economies, and as a result, prices go up. So in short, an inverse relationship between dollar and gold.
And is an inflationary environment positive for gold?
Gold is classified as a commodity, but it is also, at its core, a monetary asset. We have seen that it has a long history of being used as a medium of exchange and a store of value. And if you look at history, you will find that, the metals prices have kept pace with the global fiat money supply over the years. So, why is gold good in an inflationary environment? So what happens is, in an inflationary environment, the dollar, for example, loses its value, right? And gold tends to become more expensive. So what happens is, the owner of the gold is protected against a falling dollar, because as inflation rises and erodes the value of the dollar, the cost of every ounce of gold in those dollars rises. So in a way, the investor gets compensated for the inflation with more dollars for each ounce of gold. So, and if we take a domestic example, say over 10, 20, 30-year periods, we've seen, the average returns from gold have been around 9.5%, 10%, whereas inflation averaged around, 6.5%. So we do believe that gold, tends to beat or at least match official inflation increases over the long term, preserving its role as a store of value.
And is a recessionary environment good for gold?
Yes, it is. So if we take, different asset classes, in times of recession, the counterparty risks in, assets like bond tend to increase, right? Gold, on the other hand, cannot default or go bankrupt or fail to carry out its end of the deal, right? So its value is retained, and in spite of the recession, it tends to hold its value. So compared to bonds, gold does well during recession. Similarly, unlike equities, gold does not require a business to keep it afloat. And as we understand, a recession or bad economic conditions are not good news for equities. Whereas gold, on the other hand, tends to benefit during these episodes of recession, because people tend to park their money in relatively safer asset classes. So yes, gold benefits from economic distress and crisis. People shun risk assets like equities, bonds. They flee to gold safety, and hence it tends to attract more flows, and is an ideal asset class to help your portfolio, to get through a recession.
And how about those times when there are geopolitical tensions, say the Russia-Ukraine war, or if there is a flare-up between US and China, say over Taiwan? Would those circumstances be good for gold?
Yes, very much. So geopolitical tensions threaten, of course, peace as well as financial stability, right? And when that happens, it can be a challenging period for all asset classes. equities, bonds, currencies. But because these are risk assets, they have the potential to suffer more, which makes gold relatively better placed. And that is why we see that during these kind of geopolitical tensions, like 2022 Russia-Ukraine war, gold tends to benefit.
And purchase of gold by central banks, is that becoming a major factor in driving gold prices? We hear that central banks have been purchasing a lot of gold. And why do they do that? Why are they doing that?
Sure. So actually, central banks have been purchasing a lot of gold. 2022 was the highest on record in terms of central bank purchases of gold. They crossed 1,100 tons last year. Similarly, 2023, the first quarter has been really good. It's been another record. It's 34% higher than the previous quarterly record that was set in 2013. So they bought upwards of 220 tons in the first quarter of 2023. So definitely, central bank gold buying is supporting gold prices. We are seeing that happen. And coming to your question about why have they been buying gold in a big way? Actually, central banks have been buying gold steadily. In the last decade post the global financial crisis, because we saw quantitative easing as a policy really come in, and that's when the value of fiat currencies kind of reducing came into the picture, and that's when we saw central banks becoming net buyers of gold compared to the last decade when they were net sellers, because they wanted to hold an asset which tends to have more intrinsic value and can help counter the decreases in the value of fiat currency, given all the policy easing that we were seeing in the last decade. But coming to the now, I think 2022, the Russia-Ukraine war and the US sanctions that followed actually triggered this recent uptick in central bank gold buying. Because a lot of countries saw that our dependence on the dollar can actually be used against us in such cases where the US passed very heavy economic sanctions against Russia. So kind of in a bid to protect themselves from such things happening to them, we're seeing countries, especially China, India, Turkey, buying gold in a big way. So the geopolitics of it is definitely important. They want to diversify away from the dollar. That is important. And as well as the macro uncertainty we've seen over the last couple of years with the pandemic, and then with the high inflation of 2022, and now concerns about a global slowdown. So even this has been influencing central bank gold buying in a big way.
And how are international prices of gold linked to domestic prices? You did shed some light on it. Would you like to add something?
Yeah, so largely domestic gold prices will move in line with international gold prices because, like I mentioned, we derive our prices from international prices. But domestically, the demand and supply conditions, changes in our import duties, the strength or weakness in the rupee, these are all domestic variables that will impact our domestic prices.
I've finished with my questions. Is there anything you'd like to add? Say any advice to investors?
Sure. So I think once investors kind of appreciate, the return enhancing and risk reducing role that gold plays in their portfolio, it's also important that they, choose the right avenue or the right instrument to invest in the metal, because it can make all the difference. So I would just like to highlight, one of the most efficient and reliable ways of investing in gold currently. So gold ETFs, these are investment vehicles that invest in 24-karat physical gold. They aim to track the price of gold and generate returns in line with returns of physical gold. They are, the units are listed on the exchange and they can be bought and sold on the exchange, just like you buy and sell a share. And what's also wonderful is that through gold ETFs, you can invest in gold in denominations as low as 0.01 grams, which is, really great if, otherwise, if you go to physical gold or other avenues, the outlay is much higher, the initial outlay. Also, a lot of price efficiency that gold ETFs bring to the table. Unlike physical gold, there are no making charges or premiums. gold ETFs actually buy at wholesale prices, and those wholesale prices are passed on to the retail level. And unlike physical gold or other avenues, sometimes when you are selling your gold investment, you have to sometimes sell it at a discount. That is not the case with gold ETFs. Gold ETF units trade on the exchange very close to the market price, and you can actually be assured that you will get close to market prices when you are exiting your gold ETFs. And I think lastly, I would say, since gold ETFs require demat accounts to invest, there are also gold mutual funds that can, if investors don't want to open a demat account, or they want to do a SIP in gold, which is in fact the most ideal way to invest in gold, they can also opt for gold mutual funds.
Now, there are a lot of players offering these ETFs. What are the
Sure.
variables to look at to distinguish between whom to go for, which player to go for, which mutual
So,
funds ETF to go for?
Sure. So with ETF, now ETFs are passive vehicles, and they're trying to, like I mentioned, generate returns in line with the returns of the underlying, which in the case of gold ETFs is physical gold. So I think the most important parameter, there are many, but the most important parameter to judge and pick a good ETF would be to check its tracking error. This is a statistical way in which you come to know how well the ETF is tracking, the returns or the prices of the underlying. And because that is the intention here, you want to, invest in the underlying through this ETF. So you want to ensure that your ETF has, the lowest tracking error. I think that is the most important parameter that investors should look at.
And a lot of investors also go for sovereign gold bonds. And of course, those bonds also have their own merits. My question to you is, who should go for gold ETFs and who should opt for sovereign gold bonds?
Sure. So I think I would say both gold ETFs and sovereign gold bonds are suitable for long-term investment in gold. A couple of differences that can actually help investors chooses. So unlike gold ETFs, SGBs are not backed by gold. And many investors want that security of gold backing instead of just a government guarantee. So if that is what you're looking for, ETFs would be the preferred avenue. Also, I think one very often overlooked aspect about sovereign gold bonds is that they have a 8-year tenure, and their liquidity on the secondary markets is quite low. So if you are looking to exit before that, there's very limited liquidity, and you could be, forced to sell your bonds at a discount. So on that aspect of liquidity, gold ETFs really score over sovereign gold bonds. They're extremely liquid, like I mentioned, trade on the exchange at the prevailing market price of gold, and they can buy and sell whenever they want. So from a portfolio perspective, if you are looking to rebalance your portfolio often, buy and sell gold often, gold ETFs would be far more efficient compared to sovereign gold bonds.
Thank you, Ms. Jain. You have explained the outlook for gold very well, and also that conversation we have had about the economic variables that affect gold's price. Next time I'm reading a report from Quantum on gold's outlook, I'm sure I'll be able to interpret it much better. I'm sure our viewers will also gain much from this interaction. Thank you so much, and have a nice day.
Thank you. Thank you, Sanjay.
Goodbye.